What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk a bit about a question I receive quite often from real estate investors. Does me not being able to qualify for real estate professional status make investing in real estate not worth it? So in other words, do you need to qualify as a real estate professional to really make investing in real estate worthwhile? So we're going to talk about that a bit today. And to start, what we'll do is kind of review what real estate professional status is. No discussion about real estate professional status would be complete without a brief review of the passive activity loss rules. So Section 469 of the Internal Revenue Code governs the passive activity loss rules, which limit a taxpayer's ability to deduct losses from rental activities or other businesses in which they do not materially participate. Passive losses generally only allowed to the extent you have passive income. Losses in excess of passive income are suspended. They're carried forward until you're able to use them in the future. So you can use them against future passive income. When you dispose of a passive activity, all those suspended losses are freed up. So they're not gone. Just because they're suspended doesn't mean they're gone. So two main types of passive activities. Those are businesses in which you do not materially participate, or rental real estate. Rental real estate, by definition, is passive even if you materially participate, unless you meet one of the exceptions. One of those exceptions happens to be qualifying as a real estate professional. So real estate professional status is one of the three exceptions to the default passive activity rules for rentals. We have real estate professional status, complete disposition or the sale of the property, or you can show active participation if your modified adjusted gross income's under $100,000, and then that gives you a deduction of up to $25,000, which gets phased out as your income goes over $100K, and is fully phased out when your income's at $150,000. Well, today, obviously, our focus is on real estate professional status. So, being one of the exceptions, a lot of people want to try and achieve real estate professional status so they can deduct their losses against their active W-2 or business income. That way those losses aren't suspended and treated as passive. Real estate professional status simply gets you out of that default passive bucket. Now, to qualify as a real estate professional, there's two hurdles you need to clear. One, more than 50% of your time must be spent in real property trades or businesses. So there's actually 11 of them provided to us in the regulations. So that's development and redevelopment of real estate, construction, reconstruction of real estate, acquisition, conversion, rentals, operations, management, leasing, and brokerage activities. Brokerage, you can actually qualify under the brokerage activities by being a real estate agent. You don't necessarily have to be a broker. There's a court case out there. It's Argwal v. Commissioner, which is a tax court summary 2009-29. So that real estate agents do qualify. The second hurdle, we just said, first hurdle, more than 50% of your time in real property trades or businesses. The second hurdle is greater than 750 hours of time spent in real property trades or businesses. Now, these need to be real property trades or businesses in which you materially participate. If you file a joint return, only one spouse needs to pass this test. Now they have to clear both hurdles on their own. You can't combine spouses' time for the real estate professional status tests. So now passing both those tests, or both hurdles, greater than 50% of your time and more than 750 hours, simply gets you out of that default passive bucket for your rental activities. So your rentals, now you still need to treat it like any other business and show material participation in order to deduct your losses. So technically, you can say there's three tests: more than 50% of your time in real property trades or business, more than 750 hours, and material participation in your rental properties. Now, the regulations give us 7 tests to show material participation. Now, participation in itself is any activity performed by an individual who owns an interest in that activity. You have to have ownership. Material participation says you need to be involved in the operations on a regular, continuous, and substantial basis. Now, the 7 tests we have, about 3 are typical for qualifying as a real estate professional. So that's participating more than 500 hours during the year, or 2, you do all the work by yourself. 3, you perform at least 100 hours and more than anyone else. And the other 4 are far less common, so we're not going to worry about touching on those today. Now, if you have multiple rentals, the default position is you have to show material participation in every single one. That can be difficult. So there is a grouping election that allows you to group all your rental activities together and treat them as one. So then you have to pass one of these tests by combining your time for all your rental properties. So you can make this grouping election by attaching a statement to your return, but it's going to make proving the material participation a whole lot easier as you get more and more properties. So something we see very common, real estate professionals making this grouping election to treat their rentals as a single activity. Now, back to our original question. Does qualifying as a real estate professional, is that really necessary to make investing in real estate worthwhile? And the answer to that is no. It adds a nice bonus in terms of tax write-offs because now you can deduct your passive losses against your active W-2 or business income, but not qualifying as a real estate professional, which is not easy to do. And audits are on the rise. They're seeing a lot more in this area, real estate professional status, as well as short-term rentals. So you want to make sure you really qualify. You have all your documentation in place to support your real estate professional status. But if you don't qualify, that doesn't change anything about investing in real estate other than the tax benefit being available now against your active income rather than sometime in the future when you sell or dispose of the property. Because investing in real estate itself, and again, I'm not telling you or telling anyone to go out and invest in real estate. This is if it's something you're already passionate about, you already want to invest in real estate, don't let not qualifying as a real estate professional get in the way of that. Sure, the tax benefits are great. We work with a lot of real estate professionals to help them deduct their rental losses, but investing in real estate itself still is a great way to generate cash flow, have something in place for retirement that's spitting off cash flow each month. In fact, I would say cash flow is by far the most important and the best part of investing in real estate. So you have your cash flow. Another great benefit is loan pay down. You borrow against a property to purchase it, and your tenants are paying down your loan. Every time a loan payment is made, that principal portion increases your equity in the property. There's also the appreciation. Real estate tends to appreciate every year. So if you hold on to it long term, you're going to see a nice increase in the value of that real estate. Rental properties tend to provide inflation protection as well. Rents tend to rise with inflation. So your cash flow is going to keep up with inflation, which can help you when it comes to retirement or just using cash flow to maybe become financially free. So again, not qualifying as a real estate professional is definitely not a reason to steer clear of real estate if that's something you're already passionate about and would like to invest in. So that I wanted to cover that one because I've been asked that question several times and thought it was worth just doing a quick recording on. So that about does it for today. Hopefully you got some value out of this episode. If so, please leave a 5-star review or hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.